Analysts say the decision by the U.S. Federal Reserve to cut back on its stimulus is mainly responsible for the fall in the Naira, as offshore investors are selling off their bonds and stocks and heading to other environments. The CBN had always intervened to defend the Naira by selling huge amounts of dollars to lenders in its bid to stabilize the Nigerian currency. But with shrinking foreign reserves and lower than expected revenue from oil, the bank says it will be difficult for it to continue to defend the Naira with the foreign reserve. At its recent Bankers Committee meeting, it announced it would resort to tightening of liquidity, increasing the country's cash reserve requirement to 75% and adding that it would not hesitate to move it up to 100% if the Naira fails to stabilize.
We do not have increases in earnings from oil, and that also therefore affects the ability of the central bank to defend the Naira from the foreign reserves. We've seen statistics from the central bank in terms of the reduction, continual reduction in the balance of foreign exchange reserves. When you are confronted with that, the only options available to you is to continue to tighten.
Indeed, the country's foreign reserve has been depleting. From a peak of $48.85 billion last May, it has shrunk to $42 billion. But local manufacturers in the country say liquidity tightening would result in very high interest rates and kill some industries.
For a long time, the CBN has been tightening monetary policy. And for so long has interest rates been increasing. As we speak, interest rate ranges from between 22 to 30%. And one of the consequences of this is that it's making domestic investors uncompetitive.
The Monetary Policy Committee, however, sees things from a different perspective, arguing that it's a case of choosing the lesser of two evils.
What you don't want to do is to allow your exchange rates to go to the extent where the impact on cost of goods and services becomes so high that inflation rate is affected. Nigeria is a high import-dependent economy, and to a great extent, the impact of the cost of foreign exchange tends to affect a lot more than the cost of borrowing in the environment.
It's also the thinking of the central bank that some foreign investors may be moving out of the country for fear that the currency could be devalued, and that it needs to send a signal that that is not going to happen. Now, whether the signal is strong enough to convince these investors to stay back is a different question altogether. Deji Badmos, CCTV, Lagos, Nigeria.